Now, let's try to understand about the credit derivatives. In this session, I'm going to talk about one of the most prominent and popular credit derivative instrument, which is the credit default swap. So, we will focus on the valuation aspects of that, and once we are done with that, we will try to find out what are the credit indices that are available today, the indices on the credit default swaps, then how this entire indices based credit default swap market actually works, which is where we talk about the usage of fixed coupons, then again the usage of forwards and options on credit default swaps. Now that the underlying credit default swaps are popular, forwards, options, other derivatives are created on the top of them. And what do we mean by the basket credit default swaps? So this entire thing focuses on credit default swaps. Then we will try to understand the total return swap. How is it a credit derivative instrument? And we would also spend some time in terms of understanding the collateralized debt obligations and the role of correlation in a basket collateralized debt obligation as well as the credit default swap. How does correlation play an important role there? Right? Okay, just a quick thing. The credit derivatives as a market, it had a very big development after 1990s. But of course, once the financial crisis started in 2007, 8, 9, we have seen that the market has declined to some extent, but still it's one of the most powerful markets today in the financial sector. Simply put, whenever we talk about a credit derivative, it is a contract where the payoff depends on the credit worthiness of one or more companies. So it's a kind of an insurance contract, because the payoff depends completely on the credit worthiness of one or more companies. So if that company is defaulting, I get some benefit through this credit derivative instrument. So it is a very powerful tool. When we talk about the credit default swaps, we'll actually get into more detail, because credit default swaps is one of the most powerful credit derivative instrument today. And it allows the companies to trade credit risk exactly in the same way they can deal with their market risk. Probably you can see banks are typically giving loans. So which means they have a big portfolio of credit risk, because they give different kinds of loans. They are exposed to different forms of credit risk. So they are having a big portfolio of their credit risk. They can do an active management of that. They can keep some portion of that credit risk. They can transfer some other portion of the credit risk by entering into a credit derivative contract. They can protect themselves from too much of credit risk being piled up as well. So that is where the banks are one of the biggest buyers of credit protection. They are the ones who are the active players in the credit derivatives market as the protection buyers, whereas insurance companies have been the biggest sellers in the credit derivatives market. And when we talk about the credit derivatives, broadly we see them under two categories. One is the single name category, where the credit default swap is the most powerful instrument, or there is a multi-name category where collateralized debt obligations, CDOs, are one of the most powerful instruments there. So we'll try to have a good understanding of these two types of instruments when we are focusing more and more on credit derivatives. So let's get started with the credit default swap. Look at the definition. It's a kind of a contract which is providing a kind of an insurance, kind of protection against the risk of default. And this risk of default is a credit event. There are different kinds of credit events, right? I can talk about the default, which is more about failure to make a payment when it falls due, or we can even bring in kind of bankruptcy, any kind of restructuring of the debt, any of these things which are impacting the ability to make the payment when it is falling due is what we are calling as a credit event. So what we simply say is credit default swap is that kind of an instrument or a contract which is protecting us against the risk of a default by a particular company. Now probably let's think of this or I'll explain it in a much more detailed way, but look at it like this. Now A and B. B is a company. It has issued a bond. B has sold bonds. A has purchased them. Now A is having a risk. What if B defaults on the payment? Now this is where A will take a protection. A will enter into a credit default swap, let's say with C, saying if B defaults, I want to be protected against that default. So C will promise that in case B defaults, I'll pay you whatever is the amount that is defaulted by B. So this is in a very crude way how the credit default swap works. So it's a kind of an insurance, it's a kind of a protection that the lender or the investor in a credit in a credit instrument is getting against the default of a particular company, which is what we are calling as the reference entity. Now if you look at it, the way it works, the buyer who is bought the protection, buyer of the insurance, buyer of the protection, he has the right to sell his bond. Now in our example, A has purchased the bond, right? A can sell the bonds for a face value when a credit event occurs. So A can sell the bonds to C and C will compensate for the face value to A. So A is completely protected from the losses that are occurring because of the B's default. And the seller of insurance, who is the seller of the credit default swap, C in our example, he has to agree, it's mandatory to buy the bonds for the face value when the credit event occurs. So on the default of B, A is getting the protection from C and C is providing the protection to A. So A is the buyer of the protection, C is the seller of the protection, and B is the reference entity on whose default this whole instrument is working. And here there is a notional principle, which is the face value of the bonds that typically are being sold from the CDS buyer to the CDS seller. Now look at it like this. Let me put A, B. So B is the reference entity who has issued the bonds. So A has invested in the bonds of B. So A is subjected to risk that B can default. So A will enter into a protection with C. C is a CDS seller. Whereas A, because he is buying protection, we call him as a CDS buyer. And B is a reference entity. If B defaults, C is going to compensate A. If B defaults, C is going to compensate A. And if B does not default, C will not do anything. Now, to get that kind of a protection, the buyer of CDS, who is A here, makes a periodic payment to the seller. It's a kind of an insurance premium. Look at it from that perspective. It's a kind of a periodic payment that A is paying to C until the end of the CDS. If this CDS is being taken, if this protection is taken for a 5-year period, then A will be making payments to C for the 5-year period or until the credit event occurs. If B defaults, let's say after 3 years, then 4th and 5th years, A need not make a payment to C. And the settlement when I am saying B is defaulting. If B has defaulted, C has to make a payment to A. And that is what we are calling as settlement. Either it could be in the form of physical delivery, which means A will hand over the bonds to C, A will sell the bonds to C, and C will give the face value. So this is a physical delivery. Physically, A will sell the bonds to C and C will make the face value of those bonds. Now C will be the real owner of that particular bond. He will work out with B. That's a physical delivery. But when I say cash payment, in the cash payment mode, it is a simple workout. Okay, the current value of the bonds, right? Once B has defaulted, there is a procedure to compute the value of the bond. So if the value of the bond is, let's say 75% of the face value. If the value of this bond after the default is, let's say, 75% of the face value, then A will keep his bonds with him only and C will compensate the difference, which is the 25%. So A will not hand over the bonds to C. A will still keep the bonds, which are 75% of the face value worth, but the C will compensate for the remaining 25%, which means A has in an effective sense got the 100% out of that particular bond. So that's a kind of a cash payment. In cash payment, the bonds are not physically exchanged. It's only the cash, that is the balance, that is being paid by the protection seller to the protection buyer. And when we are using this word CDS spread is nothing but the premium. On a regular basis, how much amount is being paid per year as a percentage of the notional principal to buy the protection. And that is what we call as a spread. In some cases, we write it in terms of percentage, or in sometimes we talk it in terms of basis point, because basis point is nothing but 0.01%. 1 basis point is 0.01%. So I can talk either in terms of basis points or as a percentage of the notional principal. And today we see several large banks are acting as market makers in the CDS market. So they will get into the buy side as well as in the sell side. They have codes for buy side. So they can get into buying of a protection as well as selling of a protection. The prices are different, and the difference between the two is what is the spread which they can make a profit on. So that's a very broad introduction to the world of credit default swap. Let's look at one full flow. Suppose two parties enter into a 5-year credit default swap. Okay, so these two parties, they have entered into a credit default swap. March 20th, 2015. The notional principal 100 million. Buyer agrees to pay. This is the CDS spread. buyer agrees to pay 90 basis points per annum for protection against default by the reference entity. 90 basis points per annum. So how much is it? 0.9%. 0.9% of the face value 100 million. Right? 0.9%. So 1% is like 1 million. So it is 0.9 million. 0.9 million per annum is what is the payment the buyer agrees to pay. So let's say here A is a CDS buyer, protection buyer, B is a protection seller. So on a regular basis, right, for the whole 5-year period, on a regular basis, on a quarterly basis, the buyer will be paying a premium to the seller. Now this 90 basis points is per year. So 0.9 million is per year. So because I am paying quarterly, so it is like 0.225 million per quarter. So every quarter A will be paying 0.225 million to B until the either the 5 years period is over, which is March 20th 2020, or if the credit event happens in the between itself, from then onwards he need not make the payment. If the reference entity does not default during this 5 years, buyer receives no payoff, no benefit to the buyer, but he pays 0.225 million every quarter from that particular day onwards. Correct? If there is a credit event, there is a substantial payoff, whatever is the face value. So A can give the, if it is a physical settlement, A will give all the bonds to B, and B may pay, if the bonds are worth 100 million, B will pay as make a settlement of 100 million there. So then a credit event is occurring, the buyer will have to notify the seller. So let's assume that somewhere probably after 3 years and 2 months, the credit event has occurred. Now, I need to see within that contract whether it's a physical settlement or a cash settlement. If it is a physical settlement, now A has all the right to sell all the bonds to B, and B has to pay the face value, which is $100 million of that particular bonds, to A outright. But if it is a cash settlement, there is a process to find the value of the bonds. There is an ISDA organized auction process which will determine the mid-market value of the cheapest to deliver bond after the credit event. So there are, let's say after 1 month after the default has occurred, you find out the value of the bond. So we are talking about the mid-market value of the cheapest to deliver bond. Because as a part of the CDS agreement, just like a bond futures, as a part of the CDS agreement also, I can deliver different kinds of bonds in case of a default. They need to be of same seniority, but the price at which they are selling in the market could be completely different, which is the reason the cheapest to deliver comes into picture. So let's say if that mid-market value comes out as 60% of the face value, then the balance is being paid by the seller of the protection to the buyer of the protection. So 40% is being paid by the seller to the buyer without taking any kind of ownership of those bonds. So either of these mechanisms, and today cash settlement is a much more powerful mechanism compared to the traditional physical settlement model. So the payments wise, either it could be quarterly. Now the regular premium payment, either it could be quarterly, semi-annual, annual, and typically whenever the credit event has occurred, and from then onwards the buyer need not make any kind of payment to the seller. So that's how a traditional credit default swap actually works. And to a large extent, one of the application of a credit default swap, it is used to hedge a position in a corporate bond. The reason being, let's say I have purchased a corporate bond, uh, and at the same time I am entering into a CDS to buy a protection. So one, I have purchased a bond. So because I have purchased a corporate bond, there is a possibility of a credit risk. And to mitigate that credit risk, I have gone for a protection through a CDS. Now CDS will protect me against any kind of default of this bond. So let's say here I am getting a return of 7%, whereas here I paid 1% of the face value as a premium for the CDS. Now effectively I am actually getting 6% return because I am getting 7%, but I am shelling out 1% for the protection. So in effect I am getting only 6% here. Now what we are simply saying is this 6% is without any risk, because though this part is risky, by spending 1%, I'm buying the protection against the default of this particular entity. So which means the net 6% that I am getting is almost risk free. If that's the case, the net return that I am getting should be close to the risk free rate of return itself. If it is not the same as the risk free rate of return, then there is a possibility of arbitrage profit. So that's a major thing in terms of the pricing. If you just see, I can buy a corporate bond and I can enter into a CDS. Virtually, I am converting my corporate bond into a risk-free bond. So it does not really matter if the issuer is defaulting or not defaulting. Whatever is the scenario, I am getting my money back exactly. I'm almost risk-free, which means the rate of return that I have to get effectively in that combination where I have gone long on a bond and I have gone long on CDS, which is a protection. This two should be more or less equal to my risk-free rate of return. And so some spread of a yield on a N-year bond issued by the company over the risk-free rate should be approximately equal to the N-year CDS spread. Now, if the risk-free rate is 6%, then the spread for the CDS should be exactly equal to 1. If it is more, I can think of buying the corporate bond and buying the protection, which will give me, let's say, 6%, whereas the risk-free rate is only 5%, then I am getting a benefit of 1%. So I'll make an advantage of it. If it is on the other side lesser, then probably I'll borrow less than the risk-free rate. I can borrow it at lesser than the risk-free rate by shorting the bond and selling the CDS protection. So either way, it is going to give me a kind of an arbitrage profit, which means I can't have the situation where this equation does not work. So the typical way of looking at is spread on corporate bond right? Spread on the corporate bond should be approximately equal to company's N-year credit default spread, CDS credit default swap spread. If these two are not equal, there is a good chance of traditionally making an arbitrage opportunity. and the bond yield spread is calculated using the LIBOR or the swap rate as the risk-free rate. And what we always say is the CDS bond basis means if this changes, this also changes more or less by the same amount. So that's the reason the basis should be close to zero. The change in the spread of the corporate bond vis-a-vis the change in the CDS spread or vice versa, they should be very much going in line, which means the basis should be equal to zero. Otherwise, there is a good chance of exploiting the arbitrage opportunity in the process. Right? Now, let's talk about the valuation aspect of a credit default swap. How do I really value what is the premium that needs to be expected? So we'll take one example, we'll do an end-to-end process of that. It's calculated from the default probability estimates. One thing, right? The CDS spread is calculated from the estimates of the default probability. So here, suppose the hazard rate for the reference entity is 2% per annum for the whole of 5 years life of the CDS. Okay, it's a very important information for us. Hazard rate of the reference entity, let's say I'm taking it as 2% per annum for the whole of a 5-year life of the CDS. So let's take a spreadsheet, let's work it out. Okay, so hazard rate. So let me call this year 1, 2, 3, 4, 5. Then hazard rate is 2% per each one. So it is 2% per annum for each of the years. So based on the hazard rate, I can find out the survival probability. What is the formula for the survival probability? I can take it as e power minus lambda t. Right? The survival probability, I can take it as e to the power of minus lambda t. Lambda is nothing but my hazard rate. So for each of the years, I can calculate, cumulatively, what is the survival probability at the end of the tth period. So which I can get it as e to the power of minus lambda t, coming out to almost 0.9801 in the first year, and it is going like this. So probably I'm taking a 4-digit decimal point. So these are my survival probabilities for each of the periods. Agreed. Then unconditional probability of default, which I can look at what is the change. So if 9.9802 is the survival probability at the end of first year, what is the probability of default in the first year? It's 1 minus this. So it's around 0.0198 is the probability of default in the first year. Same way, if I am looking at the probability of default in the second year alone, it's as good as the difference between each of these, because this is the survival until the first year, this is the survival until the second year. So the default, the chances of default during the two is the difference between the two. So that's where from here onwards I'll take it as this number minus this. So the probability of default in the second year alone is this much. Similarly, probability of default in the third year alone, in the fourth year alone, in the fifth year alone works out to these numbers. So this is the chance of a default happening in the first year, in the second year, in the third, in the fourth, in the fifth. So up to here we have done our assessment. Assume that defaults always happen halfway through a year. So default is happening in the mid of the year. Right? Default is happening in the middle of the year. Payment on the credit default swaps made once a year at the end of each year. Payment is happening at the end of each year. So we have a few more information here. Defaults, I am assuming that they happen through halfway throughout the year, and the payments, the premium payments are being done once a year at the end of each year. Risk-free interest rate is 5%. So the other numbers, if I have to capture, I'll take RF, which is 5% per annum with continuous compounding, and the recovery rate is 40%. All right. So calculate the present value of the expected payments made on the CDS. So when will the payments be made? The payment is typically made during the survival. Right? The payment is typically made during the survival, because if the death has occurred or if the default has occurred, there is no need to make the premium payment except in that year when the benefit has been received. So first let's compute the present value of the expected payments made on the CDS, assuming that the payments are made at the rate of some S per year and notional principal of $1. So at the rate of S per year, right? How much is the payment that is getting made at the rate of S dollars per year? So this is the probability of survival. So if I am looking at the payment, in the first year, 0.9802 S would be paid, because S is the kind of a payment that I am expecting. In the second year, 0.9608 S would be paid. 0.9418 S would be paid. So something like that. So I can very well find out the present value of all these. S is something which is there in the background. So let's remember that S. But apart from that, which means here the survival probability, I'll do an E per RT. R and T. So I'll get the present value of the payments, not the payoffs, the premium payments. So 0.939323 S is what is the number that we are, 9324 S is what is the number that we are talking of. Similarly, I can carry on. So I end up with this being the present values of all the payments. So in a way, I'm talking about C2 by, okay, e to the power of RT. So R, let me freeze it. So what I could see is these happen to be the present value of all the payments. So the total present value of the payments, total present value of all the payments that I am making during the survival period is working out to some 4.0728 S. So this part I'll call it as 4.0728 S. So this is the amount that I am making at the end of each of the, whatever the S that I am making per year. I need to find out that S, but whatever is the S that I am paying, the present value of all those payments is coming out to be this much. Then we are talking about the present value of the expected payoff, assuming a notional principal of $1. So how much will be the payoff here? This is the payoff, because whatever is the probability of default, corresponding to that default, $1 would be typical payoff. So 0.0198 would be the typical payoff. Okay, but yes, we have said the recovery rate is 40%. So what we can say, the payoff, first of all, if I am looking at it, is, or I'll call it as expected payoff. Expected payoff, if I look at, and this is the probability of default. This multiplied by the amount, which is $1. In case the default occurs, the payoff is $1. and out of that this much is going to be recovered, so only the balance need to be paid. So that's the reason I'm saying 1 minus the recovery rate is the actual payoff. So the expected payoff here is coming out to these kind of numbers for each of the 5 years. These are my expected payoffs. Then I need to find out the present value of the expected payoffs. So I have to discount them, but here it's better that I discount them only for half a year, right? Because it is expected that the payoffs are occurring halfway through the year. So the default will happen, or the payoff has to be made halfway through. So what I'll do, if by doing the discounting, instead of discounting by 1 year, I'll discount it by half a year. Similarly here 1.5 year, 2.5 years, 3.5, 4.5. So that is what I do. So I'll do this divided by e to the power of r t. I'll take this minus 0.5 because this is what is going to happen. So the present value of the expected payoffs is what is coming out to be this number. So I can find out the total expected payoff, which is working out to this much. Total expected payoff is 0.0506. Now, so the second part is working out to 0.0506. Then consider the accrual payment made in the event of default. See, when there is a default, during that year also the payment has to be made. So these are when there is a survival. But during a year when default has occurred, even during that period also, we really need to make the payment for that particular year, which means I can find out. So there is a chance that this much is the probability of default, so this much yes should be paid at the end of 1 year, this much yes to be paid at the end of 2 years, as a third part, which is the premium payment for the defaulted year. So premium for defaulted years, if I am looking at the present value, so this much of premium has to be paid, and I'll to take the present value of even that e power r t. So the premium for the defaulted year is working out to this much, right? Because in that year of default also the payment needs to be made, which means that summation is coming out to around 0.0823s. So this part, accrual payment made in the event of default, 0.0823s, and here it is 4.0728s. And here generally I can even look at see, this is an accrual payment. Actually the only not for the full year, I can pay only up to the period when the default has occurred. So here the default is occurring in the middle, so it is sufficient that I pay half of it itself as a premium only up to the default period. So that's the reason I can even multiply it by 0.5. So 0.0411s will happen because the defaults are occurring not towards the end, so I don't need to pay the premium for the whole period, only up to the defaulted. That is what is the accrual payoff. So up to the defaulted period is what I need to make the payment, which is working out to this much. So when I am really trying to work out the whole calculation, this is coming out to 0.0411s. Now totaling it out, 4.0728s is the present value with when it is a survival. 0.0411s is the present value when there is a default. So this all is equivalent to the payoff that is coming out. So from here I can find out the value of S. So S, which is the payment that is happening per year, is simply working out as 0.0506. S is working out as 0.0506 divided by this plus this, which is working out to 0.0123. Right? If I convert it into a percentage form, it's around 1.23%. So either I call it as 123 basis points or 1.23%. So the premium that we are talking of, the CDS value that we are talking of in this example, is to the extent of 1.23%. So every year I'm expecting one party to make a payment, the protection buyer to make a payment of 1.23 percentage of the face value to the seller, who will be doing the protection in the event of default of that particular party. So that's how a credit default swap valuation. This is the value of this credit default swap. I call it either as 1.23% or 123 basis point. And a few interesting things that we have to consider here. There is a marking to market of a CDS. Every day, once you have entered into a CDS agreement, again the change in the value. Because what could be the contributors of the change in value here? Either the hazard rate could change, so or present values can keep changing, and based on that the expected payoffs also could change. So finally the CDS value on a regular basis can keep changing, which is what will contribute to the mark to market value. So it becomes either a positive or a negative. Now if we are saying find the value of swap to the protection buyer and seller in the above example, if the swap was entered sometime back at 150 basis points. Let's say earlier the swap was entered at 150 basis points. So what is the typical payment the CDS buyer is making? The payment that he is making, the present value of the payment, whatever he is making, going with the 1.5%, this plus this times S. S is 1.5%. So this much is the typical payoff, the CDS payment that the CDS buyer is making, whereas the payoff that he is getting is only this much. So which means he is paying more, right? The CDS buyer is actually paying more than what is the protection that he is getting. And what is that to the extent of? It is to the extent of this much. 0.0111 or it is 1.11%. So the buyer is paying more by 0.0111 times the principal. So the value wise, it's for the seller it is to the extent of 1.11% of the principal is the value to the seller, whereas it is minus 1.11%, which is a value to the buyer. So that's the way the traditional mark to market valuation happens on a credit default swap. And a few interesting points to remember: when you are estimating the default probabilities, we are depending on risk neutral, not the real world. And risk neutral are estimated either from the bond prices or asset swaps or some kind of CDS codes itself. So just like the way we are getting the implied volatilities in case of Black-Scholes model, here also we are trying to get the risk neutral default probabilities from any of these things by doing a reverse engineering of our calculations to get the implied hazard rate. And if we are talking about a binary credit default swap, the small difference that we are bringing in is it's exactly same as the credit default swap, but the payoff is a fixed amount. So we don't even consider the recovery rates or anything. It's a fixed amount. And so because the recovery rate is not present in kind of binary credit default swap, what is the recovery rate we are using for doing the valuation of the swap is very much important. If we are using the same recovery rate for estimating the default probability as well as valuation of the CDS, then probably the recovery rate does not play any role. Whereas in case of binary CDS, we really don't have the valuation of a CDS, right? Because there is no recovery rate in the binary CDS, it's a fixed amount that is paid. So because of that, now what is the recovery rate that I use to compute the risk neutral default probability becomes very important. So that's where for binary CDS, recovery rate is very important, especially because we would be using that to compute the risk neutral probability of default. Whereas in case of valuation of the CDS, we really don't use the recovery rate. So that's the reason what recovery rate we are using for risk neutral probability of default will impact the valuation of a binary CDS heavily, but that will not have much of an impact in the valuation of a regular CDS, right? Now, the next point which we are going to look at is the credit indices, which is more for tracking the credit default swap spreads. The participants in the credit markets, they have developed some kind of indices, just like our stock index, just like bond indices. Today, we do have the CDS indices also. Out of them, two are very popular: CDX NAIG, which is about 125 investment grade companies in North America, and iTraxx Europe, it's again 125 investment grade names in Europe. So these are the two most popular CDS indices that we see, and the composition of these indices is updated on March and September 20th every year, wherein those companies which are no longer investment grade out of these 125, they are dropped and the new investment grade companies are added to the portfolio. And if we are simply talking about a direct trading on the CDS index, so it's as good as, okay, on all the 125 companies, I want to buy a protection. Then I'm calling it as an index trade. So I can go for a CDS protection on all 125 companies as per the offer price. Again, we have a market maker for it who will quote for a bid as well as the ask price. Now, whatever is the offer price the dealer is going with, we can buy a protection on all those 125 companies at that offer price per company. So we are trying to, instead of going on one reference entity at a time, we are going with 125 reference entities at a time. So whenever one of those 125 companies default, the protection buyer receives the usual payoff from the CDS, and corresponding to that one company, let's say if the offer price is saying 0.5%. So it's as good as 0.5%. What you are paying as a protection on all 125 companies is 0.5% of the notional amount, let's say 100 million times 125. So this is what you are paying in as a premium. And now, in case one of the companies is defaulted, obviously you will receive the payoff. If it is a physical, then you will get all the 100 million, or probably if it is 100 million is per the entire portfolio. So one single bond, probably out of this, no, if I am saying 100 million is per each individual, then probably you are getting 100 million as a payoff. And from the next time onwards, the premium that you are paying is multiplied by 124 itself, because one of the companies in that list has defaulted. So that's the way the process goes. And index, whatever the offer price that we are talking of, is generally the average of the CDS spreads of all the companies, of all the 125 companies, I'll go with the average CDS spread of all of them, and that is what is generally coming out in the form of offer price. But yeah, one important thing we have to see is whatever the procedure that we have talked of in the earlier slide, it's a very simpler one. In reality, the procedure is slightly more complex. So what we say is for each underlying, in general what we see for each underlying, so all the 125 underlyings which we are taking, there are different kinds of maturities. So there is a, for each maturity again there is a coupon, there is a recovery rate. That is what happens for each of the underlying. Each underlying, each maturity, there is a coupon, there is a recovery rate. Now if that's the case, how do I traditionally go ahead in terms of directly using this kind of a formula as straightforward as this, right? So this is where the difference comes. Now if there are different kinds of underlyings that are there, the way we are computing the price is like this. You assume quarterly is the payment, generally made in arrears, and based on the quoted spread, find out the hazard rate, which you can use a kind of an iterative procedure. So it's like an implied hazard rate. So just like the way we are deriving volatility from a Black-Scholes model, the same logic we can use to get the hazard rate that is equal to the quoted spread. And corresponding to the CDS payments that we are talking of, find the duration of them, which is nothing but the spread whatever we got multiplied with that particular duration to get the present value of the spread payments. And based on that, compute the price as 100 minus 100 times the duration times the difference between the spread and the coupon, which is expressed in the decimal form. So the best way to understand it is through an example. Suppose the iTraxx index is quoted at 34 basis points. Right, today we are seeing iTraxx index, which means on this iTraxx index I have to pay 0.34% as the premium. Coupon is 40 basis points, which means the underlying bonds are making a coupon payment of around 40 basis points. All the 125 underlying bonds, they are making a payment of 40 basis points for a contract that is lasting exactly 5 years. So let me put all these things in the spreadsheet. CDS index quote. CDS index is getting quoted at 34 basis points. Coupon is 40 basis points. And the CDS maturity is 5 years. With both curves being expressed using an actual by 360 count. Now these two values are based on actual by 360. So now let's look at, okay, this is 34 and 40 on a actual by 360 day count. So probably I should convert it into an actual by actual kind of account. So probably this I'll multiply by 365 and divide by 360, which will make it around these many basis points. Similarly, the coupon is going to become these many basis points, which means my S. So we'll express these in the decimal points. So C as well as S. So probably this I can divide by, so this is the basis point. So we'll divide it by 1000, 10,000 to convert it into the decimal form. Okay, so this is 0.0034 and this is around 0.0045. Right, so probably we can retain it up to a few decimals. So 0.00345 and this is 0.00406. So these are the ones that are expressed in decimal form. Now what is that we are saying? If the yield curve is flat at 4% per year. Okay, now just like the way we have done in the earlier case, first thing I want to find out what is, right, just like in the earlier case, I really want to find out what is the expected value of the payoff, where the 40% is the recovery rate, how much of CDS premiums that I have to pay, and I will have to equate that premium to this particular quote. And based on that, we'll try to arrive at the hazard rate. Let's try to work it out. Here the payments are being made, let's say quarterly every year. Right? So here we are assuming 4 payments that are made in arrears. So if I can look at years, or probably let's look at quarters to start with. So quarter 1, quarter 2, probably I am doing the payment, let's say for 20 quarters, because it's a 20-year contract, 20 quarter contract. So I am paying at the end of 20 quarters. Okay. Now I don't know the hazard rate. Either probably this I can take in terms of years and make it like 0.25, 0.5, so that I can take the yearly rate as the hazard rate. So initially let me assume that the hazard rate, let's say, is around 1%. So across I'll take the hazard rate as 1% to start with. Okay. So which means the survival probability I can find out. Right? The survival probability for me is e to the power of minus lambda t, minus lambda times t. So this is the survival probability for each of the periods. Agreed? Yes, this is the survival probability. Then I can also find out the probability of default in that particular period. So for the first period, this is the probability of default, and from the second period onwards, I can very well find out through this exercise. So at different points, I am getting different probabilities of default. Now, I want to find out the payment. And I know that every quarter I am making a payment which is equal to, that is what I have to find out. So whatever is the survival, so I'll find out the present value directly. So the probability of survival multiplied by 1, that is what I am calling it as my payment. So I can very well go with the present value. And I know that the yield curve is flat at 4%. So yield curve, which is the risk-free rate, is 4% itself. So this is where I'll try to find out my present value. Okay, so this is the survival probability. So this much would be paid by e to the power of RT. So 4% times T. Alright. So this is the present value of all the payments that I am going to receive. Or as a CDS payer, I have to pay this much of premiums. So the total present value of the payments, if I am looking at the total present value of the payments, it is working out as the summation of all these numbers, which is working out to around 17.58 S. This is the total present value of all the payment. Same way, I can find out the present value of the payment that are being made during a period of hazard. So the payment values, the present value of the accrual payment. Assuming that during that particular period, either I may assume that the defaults are happening somewhere in the middle of each of the periods, or I can assume, so if I am assuming that the defaults are happening somewhere in the middle of each of the quarter, So this is the probability of default, and this I am multiplying it with 0.5, assuming that the defaults are happening somewhere in the middle of the period, and I will take the present value of this, which works out to be divided by e to the power of r times t. So even this s also need to be added. So I'll do the addition of this as well. So the total present value of accrual payment. This is what we have done as the earlier numerical as well. So I don't think we really need to stress on it again. So the total payment that has to be made, right? Total payment to be made, which is the expected value of the payments to be made, is coming out to the summation of these two, 17.6076. Yes. Similarly, now I'll look at expected payoff. Now this expected payoff comes from recovery rate also. So the recovery rate, I am taking it as 40%. So which means the payoff is coming purely based on the probability of death. So this is the probability of death during this period, and because the death is happening during this particular period, I would get a recovery rate as the payment. So this much payment can be expected, multiplied by, I'm assuming that, so I have to discount it. This is the payment that is expected. I'm discounting this with, under the assumption that the default is happening somewhere in the middle of the period. So I'll be discounting it with e to the power of r. Instead of t, I will be writing it as this minus 0.125, because I am assuming that the default is going to happen somewhere in the middle of the period. So my expected payoffs are coming to be somewhere around these kind of numbers. So the total expected payoff is working out to the summation of all these, which is this, and finally you are talking about, so this is the payment, this is the expected payoff. So from here I can find out the spread, which is nothing but the total expected payoff divided by the total payment. So here it is coming out that the spread is working to the extent of 0.15%. But I want the spread to be around 34 basis points. Right? So I want the spread to be 34 basis points, means I want it around 0.0034%. Right? Because I want the spread to be 34 basis points, so it is around 0.0034%, or probably I can convert this as well, whatever is the mode. Now this is where I want to work out on the hazard rate. Now I want to work backwards by setting this value equal to 0.0034%. So that's where I can do an iteration. If I'm setting this to 2%, yes, it's coming out to 0.3%. If I'm setting to 2.5, it's going to 0.38. I want it around 0.34. So I'll set it, let's say, around 2.4. It's coming to 3.36. So probably iteratively I can do the procedure. So where I can set this particular value to be around 0.34%. So which means 0.0034. And I'm trying to change this hazard rate accordingly. So I was able to make this number to be around 0.34% by changing this. Okay, so probably just work it out, 2.3 or 2.2. This is the annual hazard rate. 2.25, something like this. This is working out to be the annual hazard rate. Now this is what is working out to be the annual hazard rate in this case. So I can very well take this to be the hazard rate in this example. Right, I am getting my hazard rate, and similarly I can work out, if required I can do this on a quarterly basis as well, which means this number I am dividing by 4. I am getting the approximate quarterly hazard rate as well, around 0.56% is what I am getting as the quarterly hazard rate. Fair enough. Now I also require the duration, because we might have to multiply this by the duration. Now I know at different points what are the kind of payments that I am typically making. These are the present value of the payments that I am making. So based on this I can very well find out the duration as well. Right, if I am trying to find out the duration, it's nothing but the present values of all the payments that are being made multiplied by the time period. So I can very well do the sum product of the present values as well as the time period, giving me, okay, yeah, these are in terms of, and this I have to divide by the present value of the total. So that the total present value of the payment, which is working out to the duration divided by this, around 2.49 is coming out to be the duration. So I can very well use 100 minus 100 times the duration time. Now S and C we know, based on this we are going to find the flat price. Now if the price is more than 100, we say that the protection seller will pay to the protection buyer an initial lump sum amount. Let's say the whole value comes out to 100.5. Let me try out what it comes out to. Right, let's try out what this number comes out to. So in this case, if I want to find the price, it is, with this case, if I want to find out the price, we are simply talking about the duration, 100 minus 100 times duration times S minus C. Right? So let's look at that. 100 minus 100 times duration times S. S is the spread, minus C is the coupon. So this is working out to 100.15. This is coming out to be the price. Based on this example, the price is coming out to be 100.15, which is more than 100. So which means that 0.15% is what is the excess of the price. So in reality what happens is, the seller, the CDS seller initially pays 0.15% of this lump sum amount to the CDS buyer. So on first day, on the day of the contract, CDS seller pays 0.15% of the notional, if it is 100 million, that is being paid by the seller to the buyer. And after that, at a constant rate, I see that the CDS buyer would be making the premium payment. And what is that premium payment? We have found out that the premium payment that is making is around 0.34%. right? The premium payment that he is making is around 0.34%. And this is where we are trying to work out when the risk has actually occurred, whatever is the payment that is expected from the CDS seller, that would be the typical payment to be made. So the pricing is decided first on this basis, and if it is less than 100, the buyer would make a lump sum payment along with the premium, right? And if it is more, the buyer will not make any. See, again, here we have made an assumption that the accrual is going to happen somewhere in the defaults are going to happen somewhere in the middle. But if I don't have that kind of an assumption, the number could change slightly. So depending on the terms of the contract, the whole numbers are going to change. But what we have to really understand here is the typical pricing of the index CDS index based trade happens in this kind of a mode, right? Now, moving on to the next, which is the CDS forwards and option. If I talk about a forward credit default swap, it's an obligation to buy or sell a CDS, not today, but at a future time. So there is a forward on a swap, which is talking about not entering into the forward contract, not entering into the CDS contract today, but I want to enter into it sometime later at a future time t. So the default, the reference entity which is used for default and all, we will start looking at it only after time t. So before that itself, if the reference entity is defaulting, then obviously the forward will be get expired or cancelled off. Similarly, when I am talking about an option on a CDS, instead of an obligation, now it becomes one party will have the right whether he wants to enter into a CDS contract or not at some future point in time. If he wants to enter, then he can get into it, otherwise he can expire it. Now if you are looking at the way it is talked about, so we'll say by paying, let's say, 50 basis points after 1 year, I'm having an option to enter into a into a CDS contract for a 5 years period. Now at that point, I'll look at what is the CDS premium. If the CDS premium is 60 basis points, obviously I'm going to enter into it because this is costing me only 50. So the strike price there is the 50 basis point. If the CDS spread at that particular point is more than the strike price, I'll exercise it. That is what is the call option. Otherwise, I'll expire it. Now, whether it is the forward or an option, what we are simply saying is, if the reference entity defaults before the expiration of the contract itself, of the option or the forward contract itself, then the CDS itself will cease to exist. Right? Only after the CDS period starts, then only any default will result in the payment of the protection amount. But if the default occurs during the period itself, no protection is going to be done. Then, the next thing we have to understand regarding the CDS is the basket CDS, where instead of one single reference entity, we are talking of a number of entities, wherein different variants are there. Add up basket, payoff on any of the reference entities defaulting. It's a very costly affair. Any of the reference entities defaulting. Whereas on the other side, we talk about first to default only if the first company in that entity, in that group is defaulting, then the payment will be made. Whereas when I am talking about second to default, only when the second default occurs, the payoff will be made. The kth to default in general is only when the kth company is defaulting, only then the payoff will be made. But the payoff, whatever is made, is computed in a similar way as the regular CDS itself. So whenever the default has occurred, the settlement will happen and the swap is terminating. So none of the parties need to pay any kind of the payment. So the CDS buyer need not pay the premiums and the CDS seller need not pay any kind of protection amount once the get to default kind of a swap is settled. Now that we understood the CDS to a decent extent, one more important instrument that we'll try to understand here is the total return swap. That the word itself is saying, I will swap the total returns that I get on an instrument with some other party. In return, I may get either a fixed or some kind of a floating. So, I'm exchanging, let's say I'm talking about a bond. All the returns that come on the bond, which could include the coupons or even the appreciation in the value, capital appreciation, gain or loss. So whatever it is that is associated with that bond, I will be making the payment to one party and this party would be making some kind of predefined kind of an amount. Either it could be a fixed rate or it could be a kind of LIBOR based variable rate. So this kind of an instrument is what we call as a total return swap. Look at like this. I'm getting into a 5-year TRS agreement, notional principal of 100 million, to exchange the total return on a corporate bond for a LIBOR plus 25 basis point. So we define whether we will making the payment every quarter, every year, whatever it is, the payment frequency is what we will define at the beginning of the contract itself. So on the coupon payment dates, the payer is paying the, so here we say here this party is entering into a payer role and this party will get into a receiver role. So here payer is the one who is paying the bond returns, right? The returns of the underlying, whosoever is paying is called as a payer and whosoever is receiving the fixed is the payer, LIBOR plus 25 basis points or whatever. So on the coupon payment date, the payer is paying the coupons that are earned on an investment and the receiver is paying LIBOR plus 25 basis points on the same. So at regular intervals, the payments keep happening. So which means in a way, this person is actually receiving the bond returns as if he has purchased the bond. Right? This party is getting as if he has purchased the bond because he is getting the bond return. But actually, the bond is with A. A has purchased the bond and he is giving all the returns of that bond to B. So it looks as if the B has purchased the bond because he is getting the return. And it looks as if A has funded for it. A has funded B to purchase the bond because A is receiving some interest rate, not the bond rate. He is getting LIBOR plus 25 basis point, which is a kind of an interest rate for giving some kind of $100 million dollars to B as a loan to purchase the bond. So it can be transformed in that way as well. And at the end of the life of a swap, whatever are the change in the values of the bond, even those are exchanged. And whenever there is a default, now this is where the bond returns are typically paid here, right? So even if the bond has defaulted, the return, whatever it is, negative return is being paid by this to this, which means this party will still be funding this return, right? Because whatever is the change, gain, loss, everything is being settled. So if there is a default, the swap is usually terminated and whatever is the gap, the receiver is making a final payment excess of the 100 million over the market value of the bond. That gap is what is being funded by the receiver. So the whole risk, though A has invested in the bond, the whole risk associated with the bond is with B, not with A. So this is another way where I can really mitigate my credit risk in the process. So as I have just now mentioned, it is a very powerful financing tool because I can look at it from the perspective of the receiver. He wants 100 million to buy the bond. So he could have taken it on a loan, but he has gone for a swap. Now the payer will invest that 100 million in the bond and he will swap it with the receiver. Now payer is receiving LIBOR plus 25 basis points to buy that bond for funding it. But the ownership is with the payer, but the credit risk is much lesser because he has transferred it to the receiver. So if the bond has defaulted, the receiver will pay the balance. So the credit risk is much lesser. Rather than lending the bond, if you had lent the money to purchase the bond, probably kept the bond as a collateral, now the risk is with the payer in terms of getting that bond settled. Right? So having that collateral being used and all will be a difficult stuff there. So if the receiver is defaulting, the payer does not have any kind of a legal problem in terms of trying to realize the collateral because the ownership is with him. So that's a very, very interesting way of raising the capital. And it is more or less similar to repos where the funding is done with a kind of a security in the background. And whatever is the spread over the LIBOR that is being paid, that 25 basis points that is being paid in this example is the compensation for paying the risk that the receiver is going to default. Because if the receiver defaults, look at it, this is where correlation is playing an important role. If the receiver is defaulting and at the same time the value of that bond is also going down drastically, then where can I get the payment from the receiver? Even I can't use the collateral, even I can't use the bond to sell it off to get the money because both of them are declined. The correlation between them is so high. This is one area where we have to focus more and more. So the spread has to depend on two things. One, the credit quality of the receiver, the 25 basis points that we have defined, it has to be based on the credit quality of the receiver, the credit quality of the reference entity or the underlying bond issuer, along with the correlation between the two. So this is where the total return swap understanding becomes more and more essential. And apart from the delivery of the bond and physical delivery of the bond and getting the face value of it, we have different variants in a total return swap. Or apart from just the cash settlement, we can even talk about a physical settlement where the bond is actually delivered. Or there could be a kind of a mark to market value settlement rather than the whole settlement happening at the end. Whatever is the gain or loss, instead of settling that gain or loss at the end of the period, we can talk about a mark to market kind of settlement also at regular periodic intervals rather than settling the whole gain or loss at the end where the risk that is exposed is much higher. So some kind of variants to the traditional total return swap also could be very much seen in the market. Next, we are moving on to the other key aspect, which is the multi-name credit derivatives. Earlier we have talked about the single name credit derivatives where the credit default swaps is a more powerful instrument, or apart from that we even discussed about the total return swap, which are the single name credit derivatives. But now we talk about the multi-name credit derivatives, out of which the credit default collateralized debt obligations CDOs are going to be one of the powerful instruments. So they are simply like asset-backed securities where the underlying assets are the bonds. Look at it as simple as it. Like any other asset-backed security, but the underlying assets are the bonds. So whenever we are talking about a cash CDO, okay, whatever the whole cash pool, whatever is the pool backed by the asset bonds, that pool is divided into different tranches: senior tranche, mezzanine tranche, equity tranche. Senior tranche will be probably having a AAA kind of a credit rating, or probably a much higher credit rating. Here we have a B kind of a credit rating, and probably here it is unrated. So the tranches are designed in such a way that one is more senior than the other, and it will receive its promised set of payments of from this pool. First the payments might go to this, then to this, then to this. So this is the pool which will absorb the risk highest. This will be the next in line, and at last when all these have almost absorbed the full risk, then this particular tranche is going into a risk. That is what a typical cash CDO, the way it works. Now, the big thing, okay, here what is happening, I have taken a position in the bonds. All the bonds have been purchased, right? All the bonds have been purchased, and whatever is the underlying payment that come on the bonds, those are used as that is the asset pool. So whatever the payments that come regularly on the bonds, they are structured in this way that the investors of the CDOs, they are going to receive the payments in this particular manner. Now, the synthetic CDO is structured in a much effective manner using the CDS. Look at, I purchased a bond. I have taken a long position in a bond. So what is the risk? I have purchased the bond means I have purchased a bond means if the bond defaults, I am losing money. If the bond defaults, I am losing money. Now, I am saying that is equivalent to a short position in a CDS. I have sold the protection. There also, if the bond defaults, I am losing money. So, there is an equivalence that is created. Purchasing the bond, long position in the bond is similar in terms of risk for a short position in the CDS. If it is the same bond we are talking of, a long position of a bond is having similar kind of a risk as a short position in a CDS. Now that is the idea behind a synthetic CDO. So here, instead of physically purchasing the bonds, it goes with a short position in the CDS. So portfolio of companies and maturity, just for a reference, they are being selected, and the CDS protection is being sold on each of the companies virtually. Protection is sold, and instead of having the actual physical bonds to be purchased, the whole calculation happens on that reference bond, but no physical purchase is happening. So the CDO principal is the total notional principal of the underlying CDS. So originator is having the cash flow equal to the CDS spreads. Inflows, so you will be receiving the premium exactly equivalent to that. And when the companies are defaulting, whosoever are there in the portfolio, when the bonds that are included in the portfolio are defaulting, the payout will be made. And this part is still the same. The tranches are structured in the same way. The inflows and outflows are distributed to the tranches. But the only major advantage here is no initial investment is required, because I am not having any kind of a long position in the bonds now. I am selling the CDS protection, so directly I am getting the premiums at regular intervals of time. So there is an agreement in which the cash inflows and outflows are distributed, but there is no initial investment in case of synthetic CDO, but the whole behavior works in the form of a CDO itself. So the equity tranche, again, will be responsible for the payouts. Now if there are defaults, if any company is defaulting, one, two, more, so the first, some percentage of the payments are being taken as a risk by the equity tranche. So whatever you look at the spread, equity tranche will have a very high spread, more basis points. So probably the whatever is the spread associated with that works out to, let's say, 1000 basis points of per year on the outstanding tranche principal. Similarly, mezzanine tranche, the next some percentage will be absorbed by, so any more defaults that are occurring, let's say between 5% and 20% of the CDO principal, that would be absorbed by the mezzanine tranche. So even on the mezzanine tranche, we are talking about a premium to the extent of 100 basis points per year. Similarly, in case the defaults are going more than 20%, 20% of the companies or 20% of the loss amount, more than that is there, that is where the senior tranche is absorbing the losses. So obviously it is considered to be more and more secured. That is where the spread is to the extent of 10 basis points per year on the outstanding tranche principal. So that's how the whole synthetic CDO can be structured, where equity tranche is absorbing more of a risk in the beginning. Then after the equity tranche has absorbed almost its risk, then comes the mezzanine tranche, and only finally it's the senior tranche that is absorbing the risk. Now here a slightly more innovation has happened, where the standard portfolio means the one which we have discussed now. Different tranche holders, in a way they are selling the protection to the originator, and originator is again selling the protection to the other market participants. Whereas in a single tranche trading, so there are actually two things that are happening here. Whereas without underlying portfolio of the short CDS position, we are doing a trading of the tranche, which means virtually I have got into a short CDS position. Portfolio of short CDS positions is just used as a reference point to define the cash flows, but it is actually not created. So the buyer of the protection is paying the tranche spread to the seller of the protection, and in case the reference portfolio is defaulting, the seller of the protection is paying the amount to the buyer. Whatever are the losses on that reference portfolio of the CDSs, that is being paid. So there is a kind of an innovation that is happening step after step, which has finally resulted in the CDO trading to be finally arrived at a single tranche based trading itself. Now, one other important thing that we really need to look at is, we are talking about different reference entities packaged together. Now, because of that, the role of a correlation, especially the default correlation, becomes a very essential aspect. See, when the default correlation between the reference entities is zero, means the two bonds, they are independent. There is no dependence that if the first bond defaults, the second also defaults, and vice versa. So in that case, what happens? Any one of them may default. It's very rare that both of them will default. Right? One of them defaulting is more possible, but both of them defaulting is very, very rare. So if the correlation between them is much lesser, what we see is first to default CDS is having a very high value, because I don't know, anyone can default. Any one of them can default, because all of them are independent. Whereas the 10th to default, the chances are very less. 10 of them defaulting could be much, much lesser. Whereas if the default correlation is very high, means if one of them defaults, probably the second one also defaults. If one of them doesn't default, the second one may not default. Now, what is happening? If the defaults occur, probably both of them may default, otherwise none of them may default. Means there is some chance that the second to default, third to default, 10th to default can occur compared to the previous case. So because of that, now as the default correlation is increasing, the 10th to default, the value of that is going to increase, whereas the first to default, the value is going to decrease, because only one defaulting is a very rare chance. Probably the 10th to default is going to, the 10 of them defaulting becomes much more possible in this case. So which means when the default correlation is perfect, the extreme case, we see that the probability of one or more defaults is same as the probability of 10 or more defaults, So the chances of more number of defaults occurring will typically increase when the default correlation between them is higher. The same logic I'll apply to the tranche of a synthetic CDO also. See, correlation is very low, means only a few bonds are going to default. And if it is only few bonds that are going to default, the payment that has to be made, that is quite comfortably borne by the equity tranche. So the equity tranche is the only risky tranche there. Probably the mezzanine tranche is less risky. Senior tranche is much less risky. They are very safe. But look at, default correlation is increasing. Right? If the default correlation is increasing, now there is a chance that apart from the equity tranche, even the mezzanine tranche and even the senior tranche also may absorb the risk. Because if one defaults, many can default. If none defaults, others may not default, which means there is some chance that the equity tranche will really be beneficial. Earlier, when no relationship is there, almost every tranche, I mean equity tranche at least some default is going to occur. Whereas as the default correlation is increasing, we are simply saying there is a possibility that no default also may occur, which means the value of the equity tranche actually is going to go up. It is becoming less risky, whereas now there is some chance at least the mezzanine tranche and the senior tranches are going to go more risky. So this is where the value of those tranches is going to go down. So when the default correlation is higher and higher, we see that the junior tranches are becoming less risky, whereas the senior tranches are becoming more risky. And if the default correlation is perfect, +1, we see all the tranches are becoming equally risky, because if there is a possibility, all defaults can occur at the same time, which means all tranches will lose out, or none of them are going to default, means none of the tranches is going to lose out. In that case, all tranches are becoming equally risky, which means we could clearly understand that correlation is playing a very important role in any kind of CDS or CDO kind of structures. So this is what we typically have dealt in this chapter on credit derivatives. We had a good understanding on the credit default swaps. We took a numerical example to do the valuation of the credit default swaps. We understood credit indices, how the real trading happens with respect to the credit indices. We have used the fixed coupons model. We have looked at what do we mean by CDS forwards and options. Just had a basic conceptual understanding on the basket CDS. Talked about the total return swaps. Then we moved to the multi-name credit derivatives, where we had a decent understanding about the collateralized debt obligations, the CDOs, and towards the end spent a few minutes in terms of understanding what is the role of correlation in a basket CDS and a CDO. How does the default correlation increase the value of the different kinds of tranches as a part of the CDO, or how does it really impact the kind of the value of the either first to default or nth to default kind of basket CDS securities. So this is what I really wanted to look at as a part of this session. Thank you very much.